There's always been an innovation economy, and JP Morgan has an entire business dedicated to helping it thrive. By bringing together founders, startups, investors, and ideas, JP Morgan's commercial bank helps empower thousands of high-growth companies that are shaping the present and the future. With tailored banking solutions and a global business network, JP Morgan helps innovators scale for today and tomorrow. Visit jpmorgan.com/startups to find out how they can help you build your future. Products and services of JP Morgan Chase & Company and its affiliates are subject to availability, eligibility, and applicable terms and policies. JP Morgan Chase Bank, N.A., member FDIC.
Hey everyone, this is TechCrunch Live, where we help founders build better venture-backed businesses. I'm Kirsten Korosek, transportation editor over at TechCrunch. And today we're focused on the mobility world by taking a look at Shift, a super interesting startup turned SPAC, and one of the first online used car marketplaces that really pioneered many of the services that are now standard in the industry. Regardless of what area your startup is in, though, our two guests today have a ton of experience and advice that I think you'll find super helpful. For today's show, you can watch and listen on Facebook, YouTube, and Twitter. If you want to ask questions and apply for pitch practice for future episodes, head over to our event platform via techcrunch.com. We're using Grip, so you can register on Grip if you haven't already, and it will make it a lot easier for you to register for and attend future TechCrunch Live events. You can also use the platform, like I mentioned earlier, to ask questions of our panelists at any time during the conversation. We did make it easier to apply for pitch practice. Just fill out the form, published, and you're added onto the list. All right, let's get to our guests. First up, we have Toby Russell, co-founder of Shift, a startup founded in 2013 that went public via a merger with a special purpose acquisition company in October 2020. And before Shift, Toby was the managing VP of digital at Capital One, but he's also a serial founder. In 2007, Toby co-founded Taxi Magic, now known as Curb, an on-demand mobile transportation and booking technology company. Our other guest is Kyle Lui, general partner at Bling Capital, a seed stage fund that is comprised of former operators and founders, where he focuses on seed investments across B2B software, consumer internet, digital health, and fintech. Kyle was partner at DCM, where he led early stage US investments, including DocSend, which was acquired by Dropbox, Travel Bank, which was acquired by US Bank, Reich, which was acquired by Citrix, and Topingo, which was acquired by Grubhub. So lots of acquisition experience there. Founders may also want to pay special attention to Kyle because he was also a founder himself. He was co-founder and CEO of ChoicePass, an HR SaaS startup that was acquired by Salesforce. So again, lots of acquisition experience. All right, well, let's jump in now that we have the housekeeping taken care of. We'll have a lot to cover before the pitch practice, including kind of our focus, which is how to build products that anticipate market moves. So welcome, Toby and Kyle.
Thank you, Kristen.
Excited to be here.
Yeah, excited to be here.
Great. Well, Toby, let's jump in. Let's start with you. Give me just a brief introduction, what Shift's origin was, and then how you got involved.
So after having co-founded Taxi Magic with my co-founder George, we had been riffing on different company ideas. We knew we wanted to do another company together, and we would have like these Sunday evening kind of think sessions around what we were seeing, what we want to create. And we'd narrowed it down to two different ideas. One was around, it was like this idea of building a cruise booking service. And I had trouble getting excited about that one. But also I'd come up with this idea of, hey, buying and selling cars is totally broken. Something like 45% to 50% of all used cars sold in the US are sold not through a dealer, but private party. And I'd kind of seen that as I was looking at the fintech side of that thing, because those don't tend to be sold with loans or warranties, the kinds of things that you'd expect to be able to buy a car. And so George and I got to riffing on, I was like, I think this thing is broken and we can create a meaningfully better experience here by adding technology. And so that's what we set out to do, was make it easy for people to get cars from people to people with all the advantages a dealer would have, but without that middleman.
It's also a super fragmented market. So was that something that was particularly compelling to you because it wasn't just like there was a monopoly, but there was all these little mini markets all over the country and also really globally?
Yeah, that's something that I think became a bigger deal as we got further along in the journey, began realizing that effectively nobody had built a trusted brand in the space. We realized that the car transaction really is not just about selling a car. It's about being able to represent quality and create trust. The reason being, if you buy a new car, basically you get taken advantage of. As soon as you drive that thing off the lot, you lose thousands in depreciation. But people are afraid of buying a used car because you're like, hey, how do I know I'm going to get something good? And so being able to find high quality cars and then have a brand behind that was a big deal. The fragmentation is related to that. You get this like fly by night used car salespeople, and nobody had really built a national brand aside from kind of CarMax, like the only one out of tens, plural, of thousands of dealers in the United States. So incredibly fragmented and no real brand or real trust in the space.
So Kyle, where did you come in? Was it super early? Did you know George and Toby from, previous experience? And tell me about how that relationship began.
So I actually first heard of Shift through a friend of mine who had overlapped with George at BCG and had mentioned Shift to me. They had just closed their seed round, and so I was sort of keeping tabs, and I invested initially in the A, and I believe pretty much every subsequent round after that as a partner at DCM. And I first met George actually at a dinner in San Francisco where we sat next to each other, and he was probably 3 months from raising his Series A, and we just got to know each other, and I found him to be very compelling. And as part of diligence, I actually spoke with Toby as well. And yeah, that was how it all started.
So it's interesting, sort of a personal relationship, and that's something that founders always want, is that meeting. But another entry point is oftentimes that pitch deck. So when did he ever send you a pitch deck?
Yes, yeah, he sent me a pitch deck. I think maybe he wasn't actively raising, but like the moment that he was starting to talk to investors, he sent over a pitch deck. Yeah.
So I think this would be a good time to bring up one of the pitch decks that you shared, and I'm definitely want to walk through it sort of chronologically. But before we get to that first slide, Kyle, was there something in particular that really stood out to you on this pitch deck, or even the conversations that you had with George?
Yeah, absolutely. I mean, I think Toby alluded to some of it, but I really had a thesis around kind of building consumer brands that consumers would trust in large markets. And the used car market is massive. It is an order of magnitude larger than the new car market. And I had gone through the experience myself of buying and selling cars on Craigslist and others, and it's always like a little bit sketchy. And I really believe that there was an opportunity to, particularly at that time, to build a generational type brand. And I loved George's pitch, and there were a few things that really stood out with the pitch deck. One of which was really the slides on the consumer experience to really kind of show, hey, look, we're having consumers front and center, and that's both the significantly better experience on the seller side as well as on the buyer side.
Great. Well, let's bring that slide deck up. So if you move to the next slide, it's really like the first thing you see, and it's the founding team. And Toby, maybe you could talk to me about the decision. Do you always, in every pitch deck you've ever put together, since you are a serial founder, do you always put the founding team front and center, or is that something that moves around?
Yeah, absolutely. And I think Kyle will be able to speak this too. My thought on this is really at that early stage, you're really betting on a team. And it's the quality of the team to be able to do the thing. Like, you can come up with lots of different strategies, you can come up with lots of different technologies, but it's all going to come down to the talent that you bring together at that, particularly in that early stage. And so we've always taken a view that it's your investors betting on you as a group at being able to get from here to there and never give up. And I think that that's something that's a really critical thing. So that's a leading element of every pitch deck I've ever done.
And Kyle, would you have the same advice that, like, regardless what happens, you should open with the founding team, or
I think it's,
just be anywhere?
No, I think it depends on the stage and the type of company. But if you're a company that is in inherently a relatively kind of operationally intensive space, or an area where the core technology is an enabler as opposed to like the core differentiator, I would start with the team. At the seed stage, almost always kind of the team is one of the first slides because it is very much a people business. I think one of the things that stood out about the Shift team was they have I think 4 to 5, if we sort of include Toby and Morgan sort of like on the founding team. There's like 6 of them in total, like co-founders, which is pretty rare. And I think that was a testament to really kind of George being long-term greedy as opposed to short-term greedy, and saying I want to bring the very first best folks to be involved with the business in the very beginning, and brought on a really stellar team.
Great. Does that ever raise flags for you, red flags for you, if you see like this huge co-founding team, or do you see it more as a positive?
Sometimes it really depends on who the people are. I mean, if you have 4 co-founders that pretty much have overlapping skill sets and overlapping networks, then it could be a problem. But if you're bringing in kind of folks that are quite distinct in their different backgrounds, and there's really a reason why they should be a co-founder, then I think it's seen as a positive. Yeah.
Great. Well, let's move to the next slide. The next 2 slides, this one and then the next one, is really about the consumer app experience. This is a central piece, obviously, to Shift, because this is what you're interacting with as a consumer. So, Toby, I mean, to me, it makes sense that you would put this in here, but maybe you could give a little insight.
Yeah, so our vision was to create an end-to-end experience for the customer. So starting with buying your car, then through the ownership journey, being able to maintain that thing off of an app, and then selling your car right off of the app end to end. And then the entire thing was consumer oriented. So while a lot of companies would be like buying cars from auctions or fleets like X rental cars, our whole idea was to allow people to source cars from other people, because those are the best cars out in nature, and make that thing a completely seamless technology driven experience. So just it was really critical for us to show that experience mattered here, because that's accretive to the brand. And the reality was that, and this is still to some degree true, when you think of like used cars, what jumps to mind is not technology. Just as like when we were founding Taxi Magic in 2007, what jumped to mind when you think of taxis was like not technology. Like you think of it as a kind of technology deprived and fairly old school industry and space. And so we really wanted to emphasize that there's a transformation opportunity in the space, and that we could, with technical insight, create a completely different customer experience. And that's why we really led with that thing.
And then Kyle, just so you can weigh in on these 2 slides, was there anything that, it makes sense to lead or to have the technology as front facing, especially because it's this technology deprived market? Was there any other things you wanted to highlight that made particular sense, or actually you would have liked to have seen more of that was later added on in other series?
Oh, great question. I mean, one of the things that jumped out was the UI transpose on mobile, which is very obvious today, but at the time in 2014, smartphone penetration was really just getting into like the majority, and so that was quite unique that both the buyer and seller experiences sort of touched mobile. I think in this case, we're looking at sort of part of the kind of what we call the concierge experience, where they're kind of bringing the car, or like they also have aspects of it on the seller side. And so that was really intriguing. That jumped out. In terms of things we would have liked to see more of, which was added later, was some of the kind of auxiliary revenues around what we call F&I, essentially. So, insurance, financing, these things that tend to be huge profit drivers, I think became a bigger focus in the later stages, rightfully.
So for the founders who are in the audience listening today, so they should consider in their pitch deck showing maybe this is the core technology now, but this is where it can go. And these are add-ons and potential revenue drivers. And just even if it's not fully developed, it's important to add those. Is that what you're saying?
Yes. Yeah. at least have it in the appendix, because folks want to know, where are you going today? And then what does the company look like in, 5 to 8 or 10 years if things are really working out?
Mm-hmm. All right, let's move to the next slide. I thought this one was super interesting because it was investor objection slide I have in my notes. So why would you, Toby, maybe you could walk us through why include this in there? Is it to combat like pushback that you were getting in conversations, or why include this?
So just to clarify, the sub slide, everything beneath that black line was the original slide, and it pictured a future of Shift being a destination and a marketplace. Just threw that text up there as a reminder. And that is one of the big objections that we oftentimes get is when you put in a slide that talks about the future, you're going to get pushback on, well, how views on how the future is going to change. And so we would routinely get this pushback saying, hey, with autonomous vehicles and rideshare, like, why is anybody going to own a car at all? And so you're saying you're going to be, a destination marketplace for buying and selling cars, but nobody's going to own a car, right? And so this is a flag mostly for other founders to say, think about not just the today. And Kyle was kind of alluding to this with mobile. At the time, mobile didn't have huge adoption. If we were doing that tech slide today, we'd be talking about the metaverse and autonomous vehicles. It'd be a completely different conversation. And so what you want to think about is, what is that future world that we're going to be living in? And how does your insight play and your product play to the nature of that future world? And for us, we had to talk about, hey, yes, if cars are autonomous, guess how you're going to buy them? And we believe that car ownership won't go away. There'll be less. But the way you'll buy a car is you go online, you'll select the car you're interested, push a button, and that thing will drive itself to your house, at which point you'll buy it right there on the mobile device. And so we were saying that future, the nature of that autonomous future is going to play directly into what we're doing, because what we're doing in the immediate moment is a stage to a much broader future. Think DVDs at Netflix moving to streaming. And you need to see that vision of streaming, because you're like, we're not a DVD company, we're an entertainment company. In Shift's case, we're not a mobile, mobile app company. We are a transportation solution company.
So Kyle, is this something that you would say to all founders, is that not just be thinking about the future, but the potential objections that a founder might get from investors, and be ready to answer, kind of like how Toby just described, answer for whatever that category or industry they're in, of kind of reclassifying their company and not being put in a specific category that might have an end date. The Netflix DVD examples is a good one.
Yeah, absolutely. I think that as you pitch investors, if you hear the same question or the same objection being asked multiple times, you should probably have a slide on it, because it makes it very clear what your perspective and thinking is on it. And I see different iterations of this slide. There's also some founders or some pitch decks are very effective at showing like what you need to believe, right? Like you should be excited about us for these reasons. And so that's another way of being like, hey, this is our point of view. It's another kind of version of this.
Great. Let's go to the last slide. And Toby, why did you include this? And do you always include something like this in every series, or was it earlier on in the seed and Series A days?
Well, it was so this is actually something Kyle alluded to earlier, and we actually would put this one fairly early in the story. It's the size of the market, because people are interested in TAM. And in the case of Shift, the market is just tremendous. I mean, it's $1 trillion market. How often do you talk about, TAM and trillions? It's like rare. And so the size of this thing was such that we really did want to highlight that. And it also breaks out the components of it. There's in our case, there's the transaction on the metal, but there's also an embedded in that a fintech component. And that is, few people walk around with like $20,000 in their pocket. And so what we need to do, and we saw, was the opportunity we were the first to be able to do things like real-time dynamic pricing based on algorithms. The first to be able to do in your driveway, push a button, get real-time offers on loans based on the LTV of the vehicle. And so the different components and revenue stream opportunities that were going to be accessible by doing this through technology, we thought was important. And we wanted to say, and that's not like minor dollars, it's hundreds of billions of dollars that we're going after here.
So Kyle, if a company or founders include the TAM in here, I see this on my end all the time. I'm wondering if you have some caveats on that, because for me, oftentimes I see some really wild numbers out there. So what would you tell founders besides like be able to back up those numbers to consider when including a TAM number in the pitch deck?
So that's a great question. I think firstly on Shift, ironically, I think the used car market is one of those few markets where if you didn't have a TAM slide, it probably would be okay, because I think it's hard to dispute that certain sectors like the automobile market, the transportation market, the real estate market, like these sectors are just so massive that those are probably one of the few like kind of types of companies where like you probably don't need a TAM slide because it's so obvious. But for everybody else, it's really important to have a TAM slide and a SAM slide, because VCs are looking for the home run, and they want to know that the market that you're in is big enough. And to answer your question directly, I think that founders need to think about it both from a top down and a bottoms up perspective. And on the bottoms up side, one of the exercises that we do with our founders, or even as we're going through diligence with founders, is what do we need to believe in terms of revenue per customer and number of customers that you need to get to 100 million in gross profit? And the reason we use gross profit is because it normalizes on the margin profile, because software as a service versus like maybe software and services versus marketplaces all will have different margin profiles, but we will kind of normalize on gross profit. And based on that, what percentage of market will you own? And so that's usually a very helpful exercise from a bottoms up perspective for founders to really get a sense of, okay, what do I have to execute on? And then on top of that, you have like the macro top down, how large is your overall market and things like that. So
that's really interesting. Do you put time constraints on that 100 million gross profit, exercise, or is it something that could go indefinitely? Because I always think of like minimum viable product.
Not necessarily. Yeah. I mean, the average company from seed stage or first investment to going public is about a decade. I mean, we are long-term investors. I feel like most venture firms are long-term investors. And so they certainly don't want to see a plan in which it takes you 20 years to get to 100 million ARR. But like, I think if you have a plan where you hit 100 million ARR in 3 years, it probably isn't very realistic either.
Mm-hmm. Toby, so to wrap up the pitch deck piece, one thing you mentioned to me when we spoke earlier was you're like, well, we had a bunch of different decks for different investors. And I'm wondering if you could address that. Is this a strategy that you learned back in 2007 with your first company, where you would fine tune and change it? Or is this a practice you picked up somewhere else?
So what we found, and we kind of alluded to this earlier a little bit, is in each investor conversation, we learn something new. And I think it's valuable to think about your fundraise as a series of conversations. There's an arc, and you learn and develop, and your pitch evolves over time because people ask you profound questions that you might not have thought of, and you develop answers to those questions. And when there's a pattern of questions, you say, not only is there an answer in our back pocket, but that needs to become a part of the core, the core explanation. Because what you don't want is you don't want to have the question section at the end of the conversation always be the same set of questions. Like Kyle said, you can knock that out up front, being like, yeah, we already talked about that. Let's talk about new objections. Because in a lot of ways, what you're trying to do is identify objections or concerns, be out ahead of it, and be projecting that you've got clarity on what you're going to go do, and you've thought about the issues that are out there, and that you've got good solutions for them.
Great. Kyle, do you have anything to add to that?
No, I agree with that.
Okay. Well, I want to move past the pitch deck breakdown. We're getting some questions in, but also I had a few of my own. I was looking at the breakdown of the fundraising, and it was a seed 3.8 million, and a Series A about 24 million. The B was 50 million, so big jump. The Series C was 48 million. So slightly below, and then the Series D was 100 million in debt and equity. And so, Toby, maybe you can touch on, because I think this is something that gives founders a lot of, anxiety, maybe, of like always, having that next round be larger. What happened between the B and C round? Because you went from 50 down to 48, and how did you navigate or deal with that?
So I think it's actually a really relevant question, Kristen, to what's happening today. And that is, no matter how well you're doing or how well you've constructed your company, you're going to deal with macro realities. After the B, when we closed the B, markets were really pretty hot, and growth companies were raising at high valuations, and you could be very aggressive and get deals done. Soon thereafter, what we watched was basically markets really dried up. And in particular, we had a competitor in Silicon Valley that was doing something similar. They'd raised way more than we did. They raised like 140 million on like their A or B, and they blew all that money and collapsed. And so in particular in car e-commerce, there was like, wow, generally there was a pullback. And then in our area, people were like, we just watched the company die. Yeah, not so sure about that thing. And so what we had to do was dig in, drive toward not just growth, but profitability, and raise a smaller round so that we could maintain momentum. Internally, we also needed to take that time and build a bunch of technology because we'd scaled a bunch, and our scaling was catching up with us in terms of needing to really invest in our systems processes to help drive both gross margin profitability and bottom line profitability. And it's those times when the market does a pullback that you start thinking about profitability. You may be saying, hey, that sounds familiar. And that's because right now the Fed is raising rates and actively trying to kill companies because they're explicitly trying to raise the unemployment rate and cool inflation. When that happens, you're going to see a movement from rapid growth from companies to a move toward profitability and staying power. And if that means raising a round that is smaller than your last one to bridge you and let you invest in other things, then you do that. The final thought is people always say, hey, everything's going to always be up and to the right. It's not. From the outside, it always looks really easy. It's not. And the one important thing to bear in mind is cash and lack of cash is what kills companies, not just bad ideas or balance sheet, et cetera. It's cash. And so you always want to be mindful of your runway and what the environment you're in is. And if you're going into an environment that's a bit of a winter, and that is when there's a pullback, you want to make sure you're well capitalized, and you don't want to get stingy with things like valuations or vanity metrics of RRR raises up and to the right. You want to invest in building your product and building your company and not ever giving up.
Kyle, I want to hear from you on this, but also I want to squeeze in a question from super relevant that we receive from the audience, and it's right in this wheelhouse of macro realities, Toby, as you talked about. And the question was, what advice do you have for a company in the same space raising capital during a time that valuations of online car companies like Carvana and Vroom are at an all-time low? So it kind of, timely. Maybe you could address that question, but also weigh in on anything that Toby might have said that you found interesting.
Well, I think fundraising in any environment for a founder is challenging. It's not an easy task regardless of the environment, but in certain times it's probably an order of magnitude harder, and we're in one of those times now. And I think that also the other thing to keep in mind is that the markets turn very quickly. So even as recent as like December, there were pretty large rounds happening. I mean, it wasn't to the extent as like early 2021. But you ask a lot of like particularly growth investors today, and how many deals have you done in the last 6 months? And most of them will say 0. So I think that that's just something to keep in mind. And like there's a number of different ways in which you could fund your business. And also making sure you're going after the right types of investors. I think for Shift, for example, with the Series D, they purposely went to some strategics that felt like Shift was really what Shift was doing was the future, and have them kind of back around. And so there are a number of different pockets of capital that you can go to. But the reality is that like if you're in a space where comps have come down 50, 60, 70%, it is just going to be harder. I don't know if there's a silver bullet.
We received a bunch of questions, and since we're getting close to that pitch practice, Toby, I'm going to ask you this first one. This comes from Thomas. Does, in your opinion, companies selling cars online have problems with fraud, generally speaking? And in this area, is there any niche for anti-fraud or anti-risk solutions? So I think this is someone thinking about a potential startup idea. What's your opinion?
Definitely. Yeah. We had an active anti-fraud program, both on people spoofing and saying that they're buying a car and then stealing the car, and in terms of the financing. And it's a massive problem. In fact, arguably a big reason that 45% or so of cars that's sold private party doesn't have financing associated with it is because there's just a giant fraud problem. And that's like half the market of used cars being sold every year. A bank can't go in and reliably know that there even is a buyer and seller. Oftentimes two people will get together and say, yeah, I'll pretend to buy your car, you get a loan, and then we'll run away with the money. It's like literally the reason that fraud problem is the reason that roughly half of the used car sales in the US don't have any financing associated. It's a massive opportunity.
Kyle, do you see are you getting actually pitches in this, not just associated with online used car sales, but probably in other areas too, where anti-fraud you see as a big business opportunity?
It's a huge market, both the anti-fraud and anything kind of touching cybersecurity. I mean, it's one of the actually only areas that have where the markets have like largely held up, like those comps, and it's just because it's such a massive problem. Yeah, it continues to be a very exciting space for VCs.
Great. Well, I'm going to try to squeeze in two questions. One of mine was kind of the basis of why I was interested in talking to both of you is around the time that Shift started in 2013, there was a bunch of other online used car marketplaces. I remember getting pitched about them all the time. They were also launching. So Toby, what was the strategy to combat this competition? Or was this something that you weren't even considering? I mean, I think it particularly interested in where you decided to launch and how much you were considering the competition and sort of the volume of other startups all around 2013, 2014?
So one of the things that was our original idea was centered around financing as a fintech kind of play. And then two, that consumer to consumer. So if you look at like the largest company that grew out of the space, many people know Carvana. They actually grew as a one-sided marketplace. They were doing major brand spend to sell from auctions to consumers. They'd go to auctions, they'd buy cars, and they'd sell them to consumers. And so what we believed that was the best play was the peer-to-peer space. So we actually started as a consignment model. Our entire intent was to allow one person to sell to another person very easily. Now, long story short, as we grew, there was a bunch of user need around, hey, if I'm selling my car, I kind of like want the money up front. We noticed that as we spread to more, whatever, larger cities and outside of the Bay Area in particular. And so we modified that view, but the peer-to-peer aspect, and therefore the ability to do real-time pricing of cars was a really big deal for us and was quite differentiated. Literally no one else was doing that.
Kyle, how did you advise Toby and the rest of the founding team about, or what would you tell other founders about striking the right balance for growth and even evolving, right? Like in the example of Shift, and how to deal with an influx of other startups, maybe in a particularly hot sector at a specific time?
I think in our board meetings, we certainly paid attention to competition, but we didn't sort of like over-index on sort of what they were doing from a strategy perspective, because we had our own strategy and our own playbooks and our own perspective. And so it was sort of that balance of like, well, we should understand what's happening in the market, what are some of these other players doing, but also like we're not running their playbook, we're running our playbook.
Got it. All right.
And then also taking some of like the best in class things that maybe some best practices like kind of in the overall industry to say, hey, we should maybe explore those in a kind of like in the cheapest way possible to see if it would help Shift. And Shift is such an operational business that it requires like, hundreds of different tweaks that happen over the course of a long time that really, drive the business to kind of where it is today. So.
All right. And then squeezing in 1 minute left. One more question from an audience member. I think I'm going to throw this to Toby, but how is your experience of working with large corporate partners? For example, in terms of financing and working with large banks, how digital are their financing processes in comparison to your solution? I think another potential startup there, maybe fishing around, but Toby, what was your experience?
So mixed. So there's lots of different kinds of partners. Working with banks for financing, many of them had e-contracting capabilities, many didn't. And we had to like push them to put in place e-contracting capabilities. And that was an early limiter because the industry wasn't designed for what we were doing. I'm going to pivot and say there's another kind of working with a big partner, and that is I actually believe that most, BD and partnerships tends to be difficult and not necessarily add a lot of value, particularly if you're doing like a strategic investment. So the best kind of thing that we found was where there's like a clear, like they have peanut butter, we have bread and jelly, we're going to make a sandwich. Like it's got to be really, if it's not like blindingly obvious and very straightforward, I find that a partnership or a strategic partnership can get messy really fast. If it's not like a clear buyer, seller, customer relationship. And so those kinds of things, it can regale you with all the ins and outs of that kind of thing. But there's goodness to be had there, but you have to make sure that there's a very clear, they do X, we do Y, and it's massively complementary and not overlapping.
Kyle, would you agree with that assessment?
Yeah, I mean, whenever you're bringing two companies together for a partnership, it gets really complicated because the incentives are not always going to be fully aligned. And I would say the vast majority of partnerships don't work out the way that the parties plan to, and that was not the intent. But if you can make it work really well, like it could pay very strong dividends. That's why you got to try.
We should have a whole nother TechCrunch Live on this very topic because I find it really interesting, but we do have to move to pitch practice now. So just a reminder to our three founders who are going to be joining us, be sure your mic and camera are on. You'll have 2 minutes to make your pitch, and then Toby and Kyle will have 4 minutes to provide feedback on the pitch. All right, so first up is Danielle Kasanshin. Are you here? Is that correct? Did I completely destroy your name? Make sure your mic is on and let me know when you're ready and we'll start the clock. We can't hear you.
And now?
Yep. Now we can hear you. And sorry, can you say your name and the name of your company? And when you're ready, we'll start the clock.
Everything's fine. Good to see you.
Okay, good to see you too. All right, we're ready.
Yeah.
Go ahead and get started.
Hey, I am Daniel, a co-founder of Laoshi. Laoshi means teacher. We are building a leader in Mandarin Chinese language learning market. 200 million people in the world speak Mandarin Chinese as a second language, and they know how Mandarin Chinese is hard to learn. We started with tools for learning Mandarin Chinese that make learning easier and save their time. Our active user engagement is 5 days a week. Also, we see that more than 50% of teachers and tutors stick to our tools. Here we come with a service marketplace where students and teachers will be connected naturally. About competitors. Competitors like Duolingo and Busuu go for digital-only self-studies, ignoring 85% of the market who study Mandarin Chinese using a traditional approach. We are making a blended and combined solution. It's when you might start with digital learning, then choose your tutor for offline or online study, and Laoshi would be helpful in any type. Last month, we had 2,100 students who are actively using our app, and 200 of them are paying, average price $23. We are also currently have 235 teachers and tutors who create and share word lists with their students via our application. I have a co-founder, Sergey. He has been passionate about Mandarin Chinese learning and teaching for 10 years. Since he founded his first offline Chinese language course, he has studied courses in 6 different cities and published his textbook. Finally, the global market for Mandarin Chinese is $4 billion. We have perfect timing when the interest of the population worldwide is rising. We are currently on pre-seed stage and raised $570K. Now we are ready to raise for seed stage and growth. Thank you very much.
All right, thank you, Daniel with Laoshi. Kyle or Toby, which one of you wants to jump in first? And we have 4 minutes. Kyle?
Firstly, there were a few things that really jumped out at me. I think that when you sort of mentioned both the size of the market, your current traction, those are quite interesting. So I really liked that. I'm curious whether you mentioned a bit about your current traction, but in terms of and also the engagement numbers seemed quite good. I wanted a little bit more though in terms of whether there are like other stats around like power users or how the users really retain. When it comes to consumer, like we spend a lot of time thinking about cohort retention. And so talking about retention metrics, I think was something that you could have maybe introduced as well.
Yeah, the funny is that we developed tools for students who learn Chinese, but we have product market fit curve in retention on the side of tutors and teachers. That's funny, but we're glad to see that curve. And what about students? We have 11K active users per month, but as I mentioned, 2,000 students actively using that app. That shows that all of the other audience, they are beginners who are interested in, I don't know how to say, but might be Duolingo or Busuu. And we want to publish some course for beginners and retain that audience too.
Toby, maybe you have some thoughts, and in particular, I was thinking about what you had talked about having, these future businesses, and it sounds like Daniel kind of like talked about maybe growth. So I don't know if that's part of your feedback, but curious what your thoughts are.
Yeah, a lot of great stuff here. As Kyle said, I love that you've chosen a very big market. You've chosen like the single largest language on the planet. That's a great place to start, because if you can get that right, there's a bunch of goodness there. I really like that your co-founder has experience doing the thing you're doing in an offline fashion. So he's got subject matter expertise and knowledge, and that creates confidence that he's going to be able to navigate that and translate that into an online scalable model, which is really interesting. I may have misheard this. I think I heard that you have a model whereby you have teachers creating content for you. So I love that two-sided marketplace aspect where you're getting content creation, not just from you, but as part of your platform. My hope is that you would be able to parlay that into other languages and expand that. What I'd like to know is, why is this better than Duolingo? Why is your proprietary approach unique? And whether or not it's unique to Chinese, the character system, et cetera. How much does that translate over, literally and figuratively, to the teaching of other languages? And so I'd like to see that scalability, but and be able to double down on the confidence that your Mandarin solution is one that is gonna really hold. As Kyle said, the best data to provide is data user retention. But I also, and you guys alluded to this in your conversation, thought you talked a little about who is your core user? Is it the beginner? Is it an advancing student? Is it somebody who wants to find a tutor? Like, knowing who your core customer is and why you're going to be the best in the world at serving that core customer is really, really critical to be able to share.
Great. So would you advise then being a little bit more clear on who that core user is, but then also identifying what the potential business opportunity is on that content creation side, that two-sided business?
I think so. Also the monetization. It sounds like you're on a subscription kind of basis. It'd be interesting to see how you intend to do that and monetize over time.
Great. All right, thanks. We're all out of time. Thank you so much for joining us.
Very much, Toby, Kyle. Great questions.
Thank you
very much.
Great. Yeah, thank you. All right, our next attendee is Alex Schaffhausen, and the company is Gravy. Alex, let us know once you're ready, and as soon as you are, we will start the clock. Reminder, make sure your mic and camera are set up, and you will have 2 minutes for your pitch. Alex, are you all set?
Yep, ready to go.
All right, it's all you.
All right, so my name is Alex Schaffhausen, and I'm the founder and CEO of Gravy. So I went through a grad school program at Stanford where I studied artificial intelligence and machine learning, and I've worked in the sports and entertainment industry for over 15 years. So we at Gravy have been building in the social music space for a couple of years and have deals with the record companies that give us a similar record catalog to Spotify. The original problem we set out to solve was there is no easy way to share music with friends and your followers. So we now have an active social music platform built specifically for music sharing, chatting, and consumption. As the NFT and Web3 ecosystem matured, we had the opportunity to join the revolution. So we have since evolved, and we are now solving a much larger problem. The musician earns nothing. For every 1 million streams on Spotify, for example, they get paid only $3,000. Most cannot even pay their rent and have to work another job. And the centralized nature of Web2 music streaming make it impossible for artists to stand out. And finally, there's no way for fans to share in this upside. So we found a way using a socialized to earn token and music NFTs to make it lucrative to be a musician and a fan. Since we already have an active social streaming service in place, we are leveraging the power of Web3 to change the economics for everyone. We will own the entire vertical from NFT minting to music distribution to music streaming and social sharing. Think Twitter meets Spotify meets Web3. Fans earn tokens from sharing music, and artists can earn at least 5 times more per stream on our platform than from traditional Web2 services. So with our complete vertical integration of social streaming and Web3, we believe we will leapfrog the Web2 business models of the world. So we make money on our semi-fungible utility use subscriptions, ad-supported freemium tier, and our transaction fees. We have a full iOS beta, over 100,000 people on our waitlist, and are ready to release our Android web and iOS to the public. Institutional investors include Plug and Play Ventures and Stacks Ventures, and we're looking to close out our $3 million seed round. We are at time. Thank you.
All right, great. Thank you. Toby, I'm going to kick it off with you since I picked on Kyle first. Why don't you get started? It's obviously like a huge buzzy marketplace right now, a lot going on. Yep. So I'm really curious to hear what your thoughts are.
Me too.
Yeah, I love that you're doing an NFT model to music distribution. We've all talked about visual arts, and I think that the idea of other content and media is going to be huge. It's really exciting to see you do that. I would want to hear more. And obviously it's just like saying, hey, I'm going to do the most massive thing in digital history, because obviously music and media has always led the way, and yes, moving from Web 2 to Web 3. So you've set up a really good macro space saying, yes, general trends are with me, and if you pattern match, I'm going to be the winner. The question that I would want to go deeper on is, hey, how are you going to source the music? That is, why would an artist choose you guys or your approach? And then what does your competition look like? What are the barriers that are going to allow you to be the destination for NFT audio versus others, and getting a sense of what that supply looks like? And that's because you're trying to build a two-sided marketplace, and having done that, it's complicated. So getting really clear on what it is you're doing to source and get differentiated and better access to artists beyond, hey, you can't get paid by a record label, you can get paid by me. You might actually face some negative selection on that. So I'd love to see how you're saying, hey, how am I going to get the people who are record label worthy, but get them to come to me, because I'm going to give them a better deal long-term than a record label will. I'm using that, I know nothing from the music space. And so that's part one. Part two is I really would love to hear your user acquisition strategy. You love the number of 100,000 on waitlist. Would kind of want to say, all right, what does it look like with daily active users? And those two are going to massively correlate. More content brings more users brings more content, which means we'd love to see starting in a vertical and then spreading area to area, because it's going to be hard to get all the music and all the listeners all at the same time. So that would be kind of the thing I'd love to see in terms of your game plan to ratchet up that marketplace.
Yeah, it does. I mean, we have that in our full pitch in our deck. Can I answer that question to you right now? Do we have time for that? Or
if you can keep it super brief, because I want to hear from Kyle, that's fine.
Okay. Well, quick answer is we're doing deals direct with the labels, so the independents and the publishers. So we have Web2's deals with them, and then we're tokenizing the social sharing. So I'm random guy who loves Diplo. I share with my friends. I get paid because I'm a marketer of that music. So this works for people like me, or it could be a major athlete like LeBron James, for example, or another Twitch streamer. They all love music and they want to use that as a tool to connect with their fans. So there's more there, but we don't have a lot of time to.
So Kyle, based on the pitch, but also this new information, is there some things that he just said that would have been good to put in the, quick elevator pitch?
Firstly, I thought the pitch was very good, and you covered a lot of surface area in a short amount of time. I think the pitch was a little over-index on sort of Web 2 versus Web 3. And I think that if you're pitching Web 3 investors, they're already going to be bought into Web 3, and they already kind of have a sense of why it's better. And so having kind of focusing the pitch a bit more on how you're going to beat the Web 3 competition, which is kind of more your true competition. And then some of the dynamics that Toby talked about, which is a two-sided marketplace, is super difficult. And most of the time, in the vast majority of cases, you really have to focus on the supply side and getting the supply side right. And so I would have liked to hear a bit more about the things that are really attractive for the very best artists that you can get a hold of, or even getting, these, you mentioned Diplo and others, but like, is there like specific sectors in which you're going to be, specific genres are going to be like particularly strong in, like EDM or others, and mentioning some early signals on like that progress would have been good as well. And then lastly, just on the team and like maybe a bit more like the uniqueness of the team to tackle this problem.
Okay, totally.
Great. Thanks so much. I know it's like so much information coming at you, but I really appreciate it. And we're gonna have to say goodbye to you and then bring the final.
See you later. Thank you.
We have another Alex Matarukin with Dreamcatcher.
Yes, hello.
Alex, yes, hello. When you're ready,
Hello.
Go ahead and get started. You have 2 minutes.
Okay. Hello, my name is Alex Matarukin, and I am a CEO and co-founder of the Dreamcatcher project. Our project deals with the correction of sleeping for people suffering from the consequences of post-traumatic syndrome, as well as solving problems with insomnia. As you know, chronic insomnia affects a lot of people in the world, from 50 to 30% of the world's population. This is about 1.5 billion people. Also, about 10% of the world population, or about 500 million people, experience post-traumatic stress disorders from a larger number of social political cataclysms. Our project aims to help these people through the use of the artificial intelligence powered program that corrects human brain activity with audiovisual files and using wearable devices. We had the necessary specialists on the board, such as PhDs who in the subject and artificial intelligence engineers. Our team is additionally reinforced with the serial entrepreneur and marketers who help us to develop our project. At the moment, we have attracted about 700 followers, and which we are gradually converting to paying users. We expect that by the end of this year, we will increase the number of paying users to 3,000 people. Now we plan to enter the pre-seed round for investments in order to increase the marketing policy and the form to go to market strategy. In our estimates, we need about 500,000 euros for a good start. Thank you very much.
Great. Ended 3 seconds early. All right. Well, thank you, Alex, with Dreamcatcher. Kyle, I'll start with you. What's your initial feedback on Alex's pitch?
Yeah, so I mean, I actually really like this space. It's obviously a big market. It's a big problem that lots of people, including myself, have issues sleeping oftentimes. I think that the aspects of the pitch I really liked. I like that you brought in the credibility of saying you have PhDs on the team, and that I think I heard this, but it was like, it's very science-based. I would have liked a little bit more of that, because there are a lot of teams globally that are tackling this problem because it's such a big problem. And so spending a bit more time sort of diving into a bit more about the product and what makes it different, and then also the outcomes. So if you've run like either clinical study, whether it's university sponsored or just self-sponsored, like what were the results of that? And like, those types of stats will kind of make an investor like myself sort of pay attention, right? And really kind of cut through the noise.
Kyle.
Okay, thank you.
Yeah, quick follow-up question for you, Kyle. And especially when it comes to healthcare tech, is it important would you front load a pitch with the scientific expertise and or clinical trial, or is it okay to have it a little bit later in the pitch?
I think it's thinking about when you have a limited amount of time, what are the core things you want to convey to really drive credibility? And depending on the space, so for example, if you are solving a more kind of niche problem within healthcare, then the background of the team is going to be really, really important. When you're solving a broader problem like this, outcomes are going to be, incredibly important, because there's so many other teams kind of attempting to solve this.
Great. Toby, what are your thoughts on the pitch?
First, love that you're tackling it. Love that it's focused on PTSD. Feels like great mission. Mission is really positive, and that is a clear, relatable thing that we can all say, wow, that matters, and we really appreciate you doing it. So like you had my attention right at the outset. From there, I didn't follow what the product was. And that is like the how, the where, what are we talking about? Is it a software product? Is it a hardware product? How do you distribute it? Is it technology? Is it chemical? Is it going to be FDA regulated? And whether you're in the FDA regulation zone or not is going to be like huge. Just ask 23andMe, that was a thing. And so I think it becomes really, really valuable to get a landscape of what it is, how it works, and whether it works, evidence of that. And then what sort of, given its health tech, and again, I know nothing about health tech, the regulatory space that you're in. And then finally, based on those, it would be great to get a feel for how you intend to distribute it. Is this the kind of thing that a doctor is going to recommend? So you're going to need a, pharmaceuticals like sales staff to educate GPs on the thing. Are there particular areas, if you're focusing on PTSD, clinics, therapists, others, they're going to become the conduit for the distribution? Or is this like a direct to consumer thing? Like I was having trouble understanding enough to be able to do that. And without that understanding, I can't really assess what the probability of success is, or whether or not the product's likely to resonate. That said, as Kyle mentioned, your inclusion of the high caliber people working on it is of course really, really helpful. I just love more specificity on what's the thing we're talking about here.
Alex, can you very briefly just answer one of those questions, which is is it a software or hardware product? What is it?
Well, the product is a wearable device which avoids the problems with human brain activity. And also we work with the human brain researching institutes, and we try to get some researchers about this. So, but it's not a lot of time to explain all this.
No, understood. But based on what Toby said, and I think Kyle would probably agree, is maybe like highlighting that more. One final question, actually, Kyle, this came up at the end where Alex said or indicated the amount of money that they're hoping to raise. Is that something that you would advise, or do you think it's that a founder should leave that open-ended?
Well, as I know, the pre-seed round in healthcare vertical is about $500,000 million euros or dollars or something like that. So I draw this amount in our pitch deck.
Yeah. So
I would include the target amount that you want to raise, because it's important. There are implications around valuation and cash runway, and so it's important. It's an important thing to include.
Great. Thank you so much, Alex, for joining us, and thank you. Yeah, I know it got to squeeze a lot in, but it was great feedback. Thank you to our other two founders, Daniel and the other Alex with Gravy, and thank you, Kyle and Toby, for joining us. Amazing feedback. I think that a lot of folks definitely benefited from hearing your insights and advice. We will see you next week. And remember that you can sign up for pitch practice in advance on our platform on techcrunch.com.